Hello and welcome to Live Wire Markets. My name is Chris Conway. For today's Views from the Top, I'm sitting down with Dion Hirshhorn, Executive Chairman and Head of Equities at Yarra Capital Management, for his take on markets right now. Dion, thanks very much for sitting down with Live Wire to have a chat today.
Thanks for the opportunity.
Dion, in an interview with my colleague James Marley late last year, you referenced someone saying to you of markets, if you're not confused now, you're probably not paying attention, something that seemed to resonate with you. Has there been any clarity to be gained since then, particularly off the back of reporting season?
I'd characterise the environment now as being less confusing. Right. In the last 3 or 4 months, a few things have transpired. It's pretty clear that inflation is trending down, and two of the more significant concerns domestically were around the health of the Australian consumer, recognising the consumer might be almost 60% of GDP, and there were some pretty gloomy expectations out there, and also reporting season. So what's transpired since I probably made that comment is a high degree of resilience for the Australian consumer, recognising sort of strength with the high-end consumer is offsetting weakness at the bottom end of the landscape, and also a view that reporting season, which concluded some weeks ago, just demonstrated genuine resilience. I wouldn't call it high growth, I wouldn't call it a slump, but results met expectations. There were pockets of strength and there were areas of concern, but overall, the scorecard was solid.
Dion, in that same interview, you spoke of multiple cross currents and the need to prioritise. Can you just take us inside the Yarra war room and let us know what the big questions that you're discussing right now and how you're prioritising?
Yeah, look, as a team across our equities and our fixed income business, two of the battleground issues we're very focused on at the moment are what's happening with inflation, with a lens on if inflation is sustainably low, interest rate cuts will flow. Every stock is interest rate sensitive, some more than others, but it cuts across the entire market. So what we are seeing is clearer evidence that inflation is trending down. It's not in target yet. It hasn't been demonstrated that it will prove to remain in target. And you're going to need a high degree of confidence around that for interest rates to be cut. My personal opinion is we probably won't see cuts in Australia in the next calendar year. And with the view that although the economy is resilient, asset prices are high. And I don't think you'd want to overstimulate an economy like this. That's one battleground issue. Second battleground issue is obviously around the resources complex. Resources sector is circa 20% of our market. It's probably about 30% of the volatility in our market. And to use that phrase again, there are a lot of cross currents. And we're now at a period of time where I think we'll see greater divergence within commodities. Some commodities are almost entirely dependent on capital investment inside of China. Iron ore is a prime example. Some are far more leveraged to decarbonisation and what's happening in the developed world. Copper could well be an example of that. So they're two of the battleground issues that we're focused on here and now.
Dion, we recently saw Macquarie downgrade the Big Four. They said that they're trading at peak multiples without a clear fundamental reason. You've been well ahead of this. You've been on record as talking about the peak in earnings for the banks. What do you think happens from here in terms of downgrades, and is there a point at which you would find the banks attractive again?
Yeah, so the way we characterise the banking sector is we're open-minded, we're pragmatic. There could well be a time and a place we want to be overweight banks again. That's certainly not here and now. The economy is resilient, as I spoke of before, but banks have challenges, and these challenges are ongoing. If you look at the banking sector, margins have been in serial decline for around 20 years. Credit growth is reasonably slow. Productivity at the Big Four banks is reasonably poor. Their costs are growing a lot faster than revenue. And we're also at a period of time where bad debts are coming off the lowest level in history. So from go to zero to normal is actually a reasonable headwind to earnings. So our view is now's not the time to be stepping up and buying banks. For us to be buying banks, we'd want to see a few things in advance. We'd want to see materially lower share prices, which we think is absolutely possible, or a marked improvement in the productivity of the banking sector, just recognising that credit growth and bad debts are probably going to go against them.
Dion, at the recent Portfolio Construction Forum, you introduced the concept of the Dinosaur 7. I was intrigued to hear this term. Can you share with us what that reference means and why you're characterising them that way?
What we were trying to do is, in a shorthand way, describe the Australian market and compare and contrast that actually with the US market. What's captured everyone's attention globally has been the Magnificent Seven within the US. They're circa 30% of the S&P 500. They've had phenomenal earnings growth, and that earnings growth has really catapulted up the S&P 500. It's been an earnings-led recovery for the S&P 500. In contrast, the 7 biggest names in the Australian market are reasonably mundane businesses. You could argue in some respects they're dinosaurs that might have seen their best days. I'm obviously referring to the 4 big banks and the 3 major mining companies, BHP, Rio and Fortescue. Those 7 companies combined actually represent 35% of the ASX 200. In fact, the Australian market is more concentrated than the S&P 500, which often comes as a surprise to people. The key point of difference here is the so-called Mundane 7 in the next 12 months and the next 3 years, if you believe consensus numbers, have 0% earnings growth. So whilst the Magnificent 7 might be pushing up S&P 500 returns, our view is the biggest 7 companies in Australia could well be an anchor for our market in the medium term.
Dion, so if you're not looking so closely or not investing so much in that Dinosaur 7 as you referenced them, where are you looking in the stack?
Look, here and now we happen to think the sweet spot is outside the 20 biggest companies in the market. Once you go outside the 20 biggest companies, you're actually looking at about 35% of the ASX 200. So it's still a meaningful part of the market. But what you find once you start to go into mid-caps is that, generally speaking, they're proven business models. They've got real growth potential. You're spoiled for choice in terms of the number of companies to actually invest in. And what you also find with a lot of mid-caps is they're not hostage to Australia's growth prospects. Very often they are either a small market share, they're growing quickly, or they're an Australian business that's got a lens on global markets and expanding offshore. So whilst the 20 biggest companies tend to be mature and they tend to be at times GDP-like, small to mid-sized companies obviously have got very different growth potential. And what's interesting about mid-caps to us is, we think the risk reward's very favourable.
Dan, just a follow-up question there, if I may. How important is it that those companies can fund their own growth? Is that one of the aspects that you look at?
Look, not necessarily. We're happy to help support companies to fund growth if the returns are there. Right. The reality is we invest in businesses that are capital light, that are self-funding, and there's some really attractive attributes to that. Conversely, some businesses are capital heavy, but if they're generating good returns with good prospects, for us, often it's an advantage to deploy more capital.
The team, Dion, takes around 1,600 meetings a year as I understand it. I'm really keen to know what you're looking for when you sit down and meet with management, and is there a company in particular that has impressed you over the journey?
Oh, look, there's numerous companies, so I might get to that in a moment. Look, when we're meeting with management teams, what we're obviously focused on is a clear plan, a management team that have got the ability to execute. You're looking for a group of people that are passionate and driven and importantly focused on shareholder returns. We're also conscious that what you hear from a management team is only one part of the puzzle. And to do your analysis well, you've obviously got to speak to suppliers, competitors, ex-employees, regulators. Because what you'd find invariably is most management teams are very optimistic about the prospects of their own business, yet so many stocks don't work out. So it's our job to really qualify it. Look, we've had some long-standing investments in businesses like car sales or NextDC, where you've had strong management teams with a clear vision, very capable, track record of execution, shareholder focused, and they've compounded returns for our investors for extended periods of time.
Dion, before we talk about a couple of stock opportunities, can you just share where the portfolios are overweight in terms of sectors? We know you're underweight the banks and underweight the big 3 iron ore miners, but where are you actively hunting at the moment?
Look, a few places that look really attractive to us, and one's going to sound obvious, but I'll explain why, is the tech sector. Yep. Australia does have some fantastic tech companies. We subscribe to the view that we're probably in a low to medium growth environment. We're also in an environment where productivity is challenged, labour costs are high and getting higher. So we really want to find businesses that have got strong pricing power and really good operating leverage and limited capital intensity. And many of the technology companies we invest in, the likes of which might be car sales or Seek or PEXA, have all those attributes. So we think tech's really interesting. The other place that's interesting to us is the resources sector outside of iron ore. We think iron ore's got some pretty significant medium-term challenges where China's probably hit peak steel, but supply is going to flood that market in the next 2 to 3 years. And there are some real comparable anecdotes to what we've seen in lithium and nickel today and what we could see in iron ore in years to come. So we're very wary of iron ore, but you look outside of that, there's a lot of other resources where the supply side looks completely challenged. I'm referring to the likes of mineral sands or copper, where even if demand was to stagnate, the supply outlook is so poor, it speaks to really high commodity prices in the future.
Dan, I'll ask you about a couple of companies, but there was one question I wanted to ask you about car sales because you've referenced it a couple of times. They had the takeover strategy with Trader Interactive, I think it was in the US, where they bought half and then they bought the other half. Was that something that you liked from management, that strategy?
Yeah, we think that was a very pragmatic way to approach the task. We often say there's a graveyard full of Australian companies that have gone offshore and failed. The best examples of companies that have worked are ones that got strong IP, great track record in Australia, a high degree of humility, and they address the markets progressively. They don't do big bang acquisitions. And I think the car sales strategy has been one of sort of crawl, walk, run, and it's both lower risk and it gives them much greater insight as to their prospects.
Thanks, Dion. Let's talk about a couple of companies that you like at the moment, maybe recent buys or high conviction positions in the portfolio. What have you got for us?
Look, two things that stand out to us, one of which is PEXA. It's a digital conveyancing business. In some respects, it's been left behind in this tech rally. It's been left behind because it's actually classified as a property company for reasons I can't begin to explain. And it's been left behind because the success they've had in the Australian business, which has been phenomenal, dominant franchise, strong pricing power, awesome operating leverage, and it's literally a cash machine, has been overwhelmed by the uncertainty they have in trying to replicate a similar business in the UK. And in some respects, the losses in the UK have overshadowed the success in Australia. Our view is the UK situation will be sorted one way or another in the next 12 months. They'll either sign up big customers and it'll return to profits and growth, or they won't be in that business. And in some respects, we feel either way investors can win under those circumstances. Another area we've been a net buyer has actually been gold stocks. Recognising that the gold price is notoriously difficult to forecast, but Australian dollar gold prices, which is what we receive, not US dollar gold prices, at record highs. The gold mining companies are operating with extraordinary margins, but in the very short term, operating disappointment around output at the mines and production costs have overshadowed what's an awesome operating environment for them. So our view is short-term disappointments will be addressed. The gold remains in the ground, and over time, they'll extract it and shareholders get good returns.
Are there any names that I could press you for, Dion, in terms of the gold opportunities that you particularly like?
Yeah, look, our two preferred gold positions are Northern Star and Evolution.
Dan, I'm always keen to know, obviously, what you're interested in, but also what you're underweight. You've shared with me, or had a look at the recent updates, CSL and Macquarie, two stocks that Australian investors have a love affair with, let's be honest. What is it about these names just right now that sees you underweight?
Look, it's a tactical call here and now, recognising that both of them are actually good businesses, but good businesses and good investments at times can be completely different things. Look, CSL, just recognising the phenomenal track record it's had, our view is the future doesn't look quite as strong as the past. CSL's undertaken a few acquisitions which we think weaken the quality of the business. The businesses are more competitive, the expectations are high, and our view is if you're going to invest in healthcare, to us at least, ResMed looks a standout versus CSL. Again, Macquarie's a great franchise, storied track record. Our view is, frankly, that there could be an earnings air pocket over the next 2 to 3 years. Macquarie had extraordinary success trading energy. Those returns we think will be really difficult to replicate in the future. And equally, Macquarie's had some massive performance fees from selling infrastructure assets that were bought 5 or 10 years ago. Again, we think that's harder to replicate in the future. So it's a business that we could see ourselves owning at some point in the future, but we think earnings will get more difficult from here forward.
Dan, just one follow-up question, if I may, on CSL. You talked about some of the acquisitions that you thought may be difficult to bed down. Was it the Vifor deal?
Yeah, the Vifor deal I think is a prime example, and even their foray into flu, which overall has been successful. Our view is that the more recent acquisitions haven't been this. Again, it's all to be tested. Haven't been the business quality of the original franchise, which Australian investors have grown to love.
Dion, the interview that you're participating in today is called Views from the Top. The final question that I have for you is, what is one thing that you've realised or become privy to because of your position here at Yarra for as long as you've been in the chair?
Look, one recent observation is born out of reporting season where the team met with over 100 companies. And I guess the observation I would share is, generally speaking, inflation is coming down. But that's also making it much harder for companies to get pricing power. And it's coming at a point in time where productivity in Australia is really failing. It's been poor for an extended period of time. It appears to be getting worse rather than better. So to us, that speaks to this view that corporate Australia is probably going to have a degree of margin pressure. And we don't want to own corporate Australia. We want to own the businesses that can operate differently. So the things that we're really focused on as a team is finding businesses with strong pricing power, real margin leverage, with the view that that drives earnings, cash flow, and shareholder returns.
Dion, thanks so much for chatting with Livewire.
Pleasure. Thanks for the time.
If you enjoyed that Views from the Top as much as I did, why not give it a like? And don't forget to follow our YouTube channel because we're adding lots of great content every single week.